Hello and welcome again to the Finance Magnets Africa Summit Day 2. We're live from the Scope Markets booth number 1. My name's James Hughes, Group Head of Marketing here at Scope Markets, and I'm joined as ever by Josh Mahoney, the Chief Market Analyst at Scope Markets. We are talking today very briefly about psychology. Psychology is one of the things that's brought up quite a lot in trading, and tends to be, when everyone talks psychology, there tends to be that one old line of, well, the worst traders are emotional traders, and which of course makes sense. And then we all go, yeah, it's very hard to remove emotion from trade. And then you tend to get that, toing and froing of emotion versus no emotion, and how do you take it out, stop losses, blah, blah, blah. All goes the same. But there's a lot more to it than that, isn't there? I mean, I think when we look at psychology in trading, there's a lot more you can drill down into rather than being emotional and not being emotional and trying to act like a robot. There's so much more to it than that.
Yeah, I mean, it's interesting actually, because we've been talking to a lot of different people here at the event. Some people very experienced, some people completely inexperienced, and trying to really get across the fact that emotion, psychology, risk, that can be the most important part of trading rather than the charts itself. Being a chartist, I love staring at the charts, and I love the feeling when I feel like I've absolutely cornered the market and I know exactly where it's going to turn and exactly where it's going to go to. That's great, but the psychological element of it is the one part that if you don't have a grasp on, it's not necessarily going to work out, certainly over the longer term, because I think that without the psychological side, without the risk side of it, then things are going to be very volatile in terms of your P&L, and your longevity as a trader is always going to be questionable. So certainly it's something I thought would be worthwhile us talking about a bit, because it's something that as a new trader, a lot of the time, it's a bit boring. It's not something you want to talk about.
Yeah,
you just
want
the
risk management side as well, isn't it? Always exactly, a bit when people switch off,
Yeah, when I tell someone risk a percentage of your portfolio on each trade, that's not particularly that interesting. Whereas if I tell someone, if you use X, Y, and Z indicator, this is how it's going to tell you exactly where the market's moving. That's what people want to find out about when they start trading. But quite frankly, when I speak to very experienced traders, the fact of the matter is that they really come around to the fact that the psychological part of it can be the most difficult, especially for people that are trading by themselves at home. And when you have professional traders, they often find it quite a lonely existence. It's just them and a chart, and it's quite easy to then just stare at a chart and start making decisions that you wouldn't do otherwise, because they're doing it, quite frankly, out of not necessarily a great mindset at the time. So
I think it's interesting here because we've been talking to a lot of people here, and there seems to be there's a lot of individuals, retail traders, retail clients who are coming in, looking to trade, and they don't have a lot of experience. And I think one of the key things there is, you talk about the fact that it's a lonely existence, it's quite tough, and that emotional side of it. And what a lot of brokers tend to do is they tend to talk about demo accounts, go and get a demo account and learn how to trade. And then I've spoken to a lot of people here again that have said, oh, well, I've been trading demo account for a while, doing quite well, feel like I'm ready to move on. But the key thing about demo accounts is it's not your money that you're risking. You're not risking your own money. So there is such a different psychological aspect to trading when you're risking your own money. You behave so totally differently when you have a live trade on rather than a demo trade. Even if you're being super disciplined, you're saying, okay, I'm going to treat this as a live account, you still don't. You still fundamentally don't understand, don't have that in the back of your mind that this is my money and if it's gone, it's gone.
Well, the only difference between a demo account and a live account is the psychological element. That is literally the one thing that then gets introduced when you open a live account.
Yeah, and why a lot of people say, well, actually, this is a lot harder.
Yeah, 100%. You can be a multi-millionaire on a demo account, and as soon as you then go in and open a live account, then suddenly things completely change, and you can't put your finger on it. But the fact of the matter is, it's the psychological element of it, because as soon as you take a loss, all of a sudden, it's how you address that. How do you deal with that? You don't take a loss that poorly when you're in a demo account. No. When you've got real money on the line, all of a sudden, it's very different, you know, and your ability to bounce back from that and be able to make decisions that are in line with your trading strategy can come into question because of the fact that you start chasing, you know, and chasing trades, chasing losses can be a huge problem from a psychological aspect, because you don't like the idea of your account being lower than where it was previously. Even if you take an account and tripled the size of your account, as soon as you then lose a bit of a chunk of that, you remember that previous peak, and you think to yourself, oh, but I was there and I need to get back there as soon as possible. And so that next decision in terms of what you're trading is not the right decision. It's not the decisions you were making on the way up there. You half-ass it, you start making decisions that maybe 2 of the 3 things that you're looking for a trade, maybe you've only got 2 of them this time, but previously you waited for all 3. Yeah. And it's because you're desperate to get back up to that. So I think, you know, the art of being a good trader and the art of being a consistent trader is being able to really take yourself away from it and think, every time I lose a trade, it's a lesson, and therefore it's a benefit to me. It's not something that I need to freak out about, because it's part and parcel of being a trader.
Yeah, and I think this comes back to one of the things we said yesterday, that the most successful traders tend to be the ones that lose money well. Yeah. Kind of understand the fact that they will lose money at some point and take those as lessons, you know. And I think one of the key psychological aspects of trading is we're taught so much, you know. You could go around this entire expo. People are trying to teach you everything. There's an auditorium in the corner where people are pushing educational content out the whole time, teaching you how to trade, doing this, doing that. However, I think one of the key things around the psychology of trading is understanding that you're not going to get a perfect trade. We wait for all of those key things. You know, I'm going to wait for this point to hit. I want to hit that level. Yeah. I want to have my risk reward at exactly this. I want the fundamentals and the technicals to all marry up. The key thing is, if you wait that long for a trade, you wait for those things for a trade, you will never trade. You won't place a trade, because those perfect trades don't exist necessarily.
And you can spend your time constantly looking at the markets, just staring, waiting for these certain things to happen. Really depends on how deep you go in it. You know, one of the things I was talking to someone earlier about was try trading on a 1-for-1 risk reward basis for every single trade, right? Because essentially it's a coin toss. So one of the problems is that people go into trades thinking this next trade is going to be the one that's going to double my account, right? And so they take on too much risk and they attach too much importance to the next trade. And it's when you get married to that next trade that you start doing silly things like you move your stop loss further away because you really don't want this one to be wrong, because you waited 2 days for this setup to happen. And so you really just start to stretch it. So the thing about taking trades where you're doing 1-for-1 trades is it's not necessarily that exciting. And therefore it kind of takes some of that psychological side out of it, because also your losses aren't huge, your profits aren't huge, but ultimately it comes down to your ability to read trends and move on side with those trends. So sometimes just trying to do these different exercises that take the psychological side out of it a little bit. Set and forget trades as well. Don't stare at your trades the whole time. Open it. You've got a stop loss, take profit there, let it play out, and then you can approach it later and look back at it and see exactly what went right, what went wrong, rather than really micromanaging the entire trade and just feeling the emotions throughout the whole thing on a 1-minute chart.
Yeah, I think one of that most important part there is taking that. Every trade is different. You know, you take a trade, you finish it, you move on, you get the next thing. There's something that someone that we both know actually always used to say is that when you trade, also take the wins. You know, when you win, when you make money on a trade, take it. Take some out. Have a withdrawal. Go and buy something. Yeah. You know, go and spend it. Go and get yourself a new shirt.
You won yourself a shirt. That was the line.
Yeah. You won yourself a shirt. Well done. You know, you won yourself a couple of pints in the bar. You know, take it out and make it real. Yeah. Because you never make it real by sitting there. Okay, I won a trade. I'm now going to lose it all on the next one. Yeah, you know, you never make that definition between, okay, I've got a trade and I've done well, but now I need to do something. Exactly. You've won a shirt. Go and get yourself a new shirt. Go and buy yourself a new pair of shoes or whatever it is.
Do you know one of the most dangerous things for a trader is confidence?
Yeah.
The moment that you start feeling overly confident, the moment that you think, oh, I've got this whole trading thing sussed out, that's the moment that you start sometimes taking too much risk. And you start becoming a little bit lax because it becomes easy to you. And the fact of the matter is, you'll go through good periods, you'll go through bad periods. It's the way that you manage the drawdowns that will define you more so than the periods where things are going great. So I think that's going to be really key. So I think the psychological aspect, absolutely critical for traders. When they first start trading, they think it's the boring part. But the longer you become in this trading game, the more you start to realize that's the key to staying in the game for a long period of time.
100%. And I think that sounds like an amazing place to end that. I mean, psychology of trading is key. Psychology is absolutely fundamental in what you do, but so are a lot of the things that we mentioned. Psychology, risk management, is getting around all of them. Keep an eye out on our channels for more of this sort of content as we go forward. There's going to be much more of this sort of content coming out. There's going to be more of this content coming out today, live from the show. Obviously, we're in the second day here. We're winding down to the end of the session. But there's a lot going on. We're going to be talking about the US CPI later, talking about a few different points coming out. But for now, thanks for watching and stay tuned. Hi guys, we are back and at the Finance Magnets Africa Summit, day 2, booth number 1, Scope Markets booth. We're back talking markets this time. So we're doing a bit of a live market reaction because in the space of the last hour, of course, we've had the release of the big number for this week, which is the US CPI data. So US CPI data has been released. Markets are moving. Josh, you've been taking a look at what's come out as your role as Chief Market Analyst. What's their headlines?
Well, the headline is that we've seen US CPI drop both on the headline basis and we've seen the core reading drop. So 0.1 decline in both of those figures. Bearing in mind this comes off the back of a US jobs report that was strong, but the key at the moment isn't the jobs numbers. The key is inflation. So everyone was looking towards this as a gauge of what the Federal Reserve is going to be looking at going forward. And it's a positive. I mean, ultimately, it's moving in the right direction. Interestingly, we've seen, as expected, 0.4% on the month-on-month basis, but on both of those fronts, on the core and the headline reading. So if you can extrapolate that out across the entirety of the year, that would mean 4.8%. So really the headline number at the moment is 4.9. So the month on month is pretty much pointing towards it staying where it is and sticking around this area. And then the core reading, it's at 5.5. So that means that we are expecting that to continue to move towards the downside. So good news.
This is good news actually. And we were talking on a panel yesterday. I moderated a panel where we were talking about markets. One of the key topics were around Q2. What's the big stories for Q2? What's been the big stories in Q1? Of course, inflation is the big story. And I think one of the interesting points that came up yesterday was the fact we were saying that, well, there's this old-fashioned 2% target rate, 2% target mandate for the Fed, for the Bank of England. I mean, pretty much 2% globally, you know. And a lot of the panelists there were saying, with the Fed, with a lot of other areas, there's no way this gets down to 2% again. But we are moving in these sorts of directions. I mean, these numbers are moving lower. Of course, we're not at 2%, but still, we're moving in the right direction from that perspective.
But there's a big problem here, because if you look at the breakdown of inflation, we've now stripped out all the energy elements, right? So that was the easy part to get rid of. As long as energy came down and stayed down for a bit, then that comes away. So now that's the top layer that's gone, right? And now we're looking at other elements like food prices. That's pretty much flat at the moment. So we're seeing some of those effects coming out. So that's good news. Pretty much the main determinant of inflation at the moment is services inflation, and all of that is being driven by housing prices. Yeah. So as long as the housing sector is strong, then we're looking at
big celebration going on over here somewhere.
As long as the housing market's strong, then arguably that remaining element that is keeping inflation propped up is going to stay there. So are we now looking at a position where the Federal Reserve has to try and crash the housing market to some degree? That's not great news, because if you look at where everyone's money is, that certainly here in the UK, the bulk of your assets for a lot of people is in your mortgage, is in your house. Yeah. You borrow off the back of that. When the value of your house goes up, you're able to then withdraw cash and then utilize that to then make investments. So if you start having to force the housing market into retreat as a means to then drive down the remainder of that inflation figure, then that's bad news. So at the moment, if we're looking at the market reaction, we've seen equity markets popping higher. Certainly people feeling like this could mean that we're going to see essentially that terminal rate, that flatlining in terms of interest rates from the Federal Reserve.
I mean, that's the key thing, isn't it? So the key thing that we have to take from the inflation today was, what does that mean for rates? What does that then mean for the Fed? Of course, just last week, one more rate hike we had. The idea was that's the last one. Jerome Powell was a little bit like, maybe not.
Left the door open.
Yeah, so maybe this maybe means that, okay, maybe it is a little bit easier for them to keep rates as is now for a little while.
Yes, I mean, look, ultimately in an ideal world, you've got a strong economy, i.e. the jobs numbers are good, which was the case, and unemployment remains low, and inflation continues to move towards the downside. That's an ideal situation, and we're seeing that to a degree, but look, we're at 5% essentially, and we're moving down at 0.1% on a year-on-year basis. That isn't anywhere near that 2% target. And we have seen central bankers essentially say, well, once we reach 2%, then we'll have that discussion. Yeah. So as it stands, they're not looking to really move from that 2% target. And we're now into the layer of inflation that is a lot more sticky, a lot more difficult to drive down. So yes, they could potentially pause, but what if then inflation just flatlines essentially? Like I said, 0.4% on a month-on-month basis points towards 4.8% in terms of that headline figure. We're at 4.9%, so there's nothing on the month-on-month basis to say we're going to go much lower than here.
So even if we did see the Federal Reserve pause and the markets really enjoy it, which at the moment we're seeing some positivity, I do think that it's a conversation that could play out a few months down the line. That if we see it flatlining, then essentially the Fed are going to think maybe we have to push it a little bit further, and that's when you start to see risk attitudes really start to change.
Yeah, and I think the interesting part around this as well is you talk about we're in that sticky part of inflation now. Now, those non-sticky parts were kind of the bits that were directly affected by the war in Ukraine. You know, the Russia-Ukraine war with oil prices, energy prices being one of them. Oil prices were up at $120 odd a barrel.
Federal Reserve action.
No, exactly. No. Not things that the Fed can necessarily control. Energy prices were really high. Oil prices were really high. That's come right down. You know, that's come right off. Food prices, as you said, they're leveling out a bit. You know, so it is now all down to the Fed to control this. And if they can't, it leaves that mandate in a very sticky position.
Well, look, the one thing they can impact, negatively so, is the housing market.
Yeah.
And that is the thing that remains, essentially. It's the shelter prices, the element of shelter. And certainly if you look at your everyday person, maybe their mortgage payments are going to be a huge portion of their outgoings. So it makes sense that that is a significant part of the inflation picture. And so, you know, I don't want to see the housing market crash, but that's certainly something that we have to look out for. If the housing market remains strong, then that actually could be bad news in terms of the inflation figure, because it's going to be relatively sticky and stay relatively high.
But isn't this then in a little bit of a catch-22 situation? Because if rates keep going high, mortgage payments keep going high, okay, then you, at the same point you want house prices to start falling to be able to keep this. That stinks of 2008 housing crisis where people can't afford mortgage payments.
I mean,
we're already in a bit of a banking crisis situation anyway, on teetering on the edge with some of these smaller banks going, pushing banks and starting to push people on mortgage payments. These mortgage payments are getting higher and higher. That's why the Fed obviously want to slow down. But it's kind of this area it's a very much a tightrope at the moment.
I mean, look, one way of looking at it is if you weaken the economy, then affordability levels will decline in terms of people that are renting. So someone that owns a property may then think, well, you know, maybe the demand's not there at these prices, I'll then have to drop it a little bit, and then that will help the dynamic in terms of inflation. But then the flip side, as you allude to there, is that if they keep it raising interest rates, that person with the mortgage that then is renting it out suddenly has higher payments, and that's just going to get passed on, quite frankly. So, you know, it's not necessarily a very clear, direct correlation between, we're just going to raise rates and the housing market's going to weaken to the point where we're going to see the costs to your everyday person going to decline. There's more to it than that, and it's not necessarily going to be a great thing that if they're essentially trying to crash the housing market as a way to resolve this. So look, if we're looking at the way that the markets are taking it at the moment, they're seeing it as a positive. We're seeing a move out of havens, so we're seeing the US dollar weaken. We're going to see the likes of euro dollar rising, Australian dollar against it, you know, pound against the US dollar. We're going to see people moving into equity markets because they start to think, great, this is the end of the tightening cycle. But like we're talking about here, you know, there's a lot more to it from the perspective of whether this move into a sort of flatlining in terms of interest rates is going to be sustainable. Just a nod as well. I know that a lot of the people that follow in this stream are talking about gold, so we just wanted to talk about that. Gold doing particularly well. Bear in mind, by and large, gold is valued in US dollars. So when we're looking at risk-on moves, so if you're looking for upside in equity markets, which is what we're seeing at the moment, you're expecting to see US dollar weakness, you're expecting to see strength for gold. The flip side of it is, as we're talking about now, let's say 1, 2, 3 months down the line, if we saw inflation essentially flatlining, or we start to see it turn upwards once again, or if you saw energy prices start to spike, then you start to see questions about, is this feasible that we're going to see interest rates flatline and then start to come off? If that comes under question, you're likely to see gold then start to weaken.
Yeah, so what's the, obviously we've looked at this from a real, from a macro perspective, looked at what the data means. I know there's a lot of people watching the stream and asking a lot of questions, which is great. Thank you for your questions. Keep those questions coming in. But obviously, gold is one. What from a trader's perspective, what's been the reaction in some of these areas, and what, from a trader's perspective, should we be looking at, in the next couple of days or so, or in the next few hours, probably more important than the next couple of days?
Yeah, okay. So the way that I'm looking at it at the moment is we're seeing risk on in terms of equity markets. The one area that's really come out of this earnings season with strength for me has been some of the big tech stocks.
Yeah.
So I would say if I'm looking to play equity market strength, I'll be looking towards the likes of the NASDAQ in particular, because it's very heavily geared towards those tech plays. Then if we're looking at, say, the FX market, we're talking about US dollar weakness at the moment, and I think that's likely to be a theme that will carry on throughout this week.
Yeah.
But then we need to trade it against something. And the thing that I'm looking at the moment's got to be the UK. I mean, ultimately we're 10.1% in the UK CPI reading, and so that gap is just widening and widening as we see US inflation come towards the downside. So that leads us very conveniently to what's happening tomorrow. We've got the Bank of England coming out.
Yeah, still a lot coming out this week.
Decision. Yep. So, ultimately we're looking for that 25 basis point move, but I don't think that's going to be the big ticket, because even if we see it, that's not necessarily going to move the market in the same way as the comments around it and the outlook from the Bank of England. At 10.1%, can you rest on your laurels and think that that's it, and now we're just going to sit here on our hands and inflation will soon enough come towards the downside? I don't necessarily think so. So if they come out and show that they are willing to continue to raise rates, and we're seeing the likes of the Federal Reserve moving into this period where they're going to potentially flatline in rates, you're likely to see the pound against the US dollar, i.e. cable, continue to move towards the upside in a strong way, and we'll see outperformance for the pound.
That is an interesting point, isn't it? That central bank divergence. That's something that we were speaking about a lot back when we were waiting for these central banks to raise rates. The eurozone, the ECB, they didn't raise rates for a long time. In the UK. And again, I suppose let's look at that bank situation, transfer what we spoke about from the US to the UK a minute. Now that's even an even more treacherous situation in the UK, because you have that point where inflation is still at 10.1%, you're still raising interest rates, people's mortgage payments exactly the same way are getting hit. Okay, the housing market is still there or thereabouts in the right place, but there is a point in the UK where we'll get to a stage, and I know we touched on this yesterday, but what do you do to control this? And this is what the Bank of England will be dealing with tomorrow. They have this situation where we are in this will they, won't they raise rates, not tomorrow, but going forward. What sort of position does that then leave the UK in when all of these interest rates hikes are doing nothing to the inflation price? The cost of living is still getting more expensive, but at the same time, you're slamming people's mortgage payments higher. Yeah. It is just a real recipe for disaster.
It's a problem, and also bear in mind that people's mortgages roll over at different times.
Yeah.
So if you're lucky enough to be, when they first started raising rates and saying, oh great, I've got 2 years on my mortgage until I have to renew that. Well, actually, soon enough, these things come round.
Yeah.
If they can't resolve this quickly. And the problem is that inflation is built on expectations. If inflation is coming off, then people start to expect that inflation will come down.
Yeah.
If UK inflation can't get away from this 10% mark, and they can't do it quickly, then people expect inflation to remain at 10%, and they start making decisions accordingly. When they go back to their boss that I want a 10% pay rise, they don't say, oh, well, okay, yeah, inflation will probably be 3% in a few months' time, so I'll take a 3% pay rise.
Yeah.
So then that gets passed on to the consumer, and it's a self-fulfilling problem that they've got there. So the Bank of England needs to act now. It needs to act decisively. I don't think they have the ability to just hold off for a bit and hope that things start to turn in its favour. So I think this is going to be a really interesting one. If they do act decisively, then that uptrend that we've been seeing in terms of cable is going to be something that's really going to be powering onwards and upwards going forward. And certainly when we're looking at the breakdown in terms of inflation, like I said, the energy component, the price of food in the US, that started to come off in a meaningful manner. In the UK, it's a wider spread, and in part that's because of the fact we've got the problems of Brexit, we've got higher import costs, we've got friction in terms of trade, and that's not necessarily something that they're going to be able to resolve very easily at the Bank of England. So they're in a bit of a rock and a hard place at the moment, and I think we're likely to continue to see pound strength because of that. As long as UK inflation remains high, I think the pound will stay strong.
Yeah, so what do we look at then? I suppose the factor is that we could be saying, okay, where are some of these safe haven things that we look at? The yen's been interesting over the last few weeks or so. That the yen is a bit of a safe haven. Gold, I know we've already touched on gold, but gold's a bit of, I know we said yesterday how much that safe haven thing is a bit of a old-fashioned one, but if you're in a situation where you don't know what's going on with rates, and gold is particularly strong, then it becomes quite a nice, easy situation for people to step into. Of course, there are no easy situations. These things can go anywhere. The one thing me and Josh do not know, and this is something which is echoed everywhere around this room, is none of us have any idea where the market's going to go. We're speculating and trying to find out ourselves. But, you know, these movements are really interesting ones. But if you look then at the yen, at gold, are there easier ways to maybe cut out the mess that's going on over here and look at something where it maybe is a little bit more stable?
Yeah, but what I would say is that market sentiment is all driven by US markets in particular, and US markets are driven by those big tech stocks. As long as they're performing well, I think equity markets will hold up relatively well, and that means we're likely to see people continue to move away from those safe haven assets. The Japanese inflation picture still remains very low. The US inflation picture is coming down, so I think we're likely to see continued move out of those haven assets. There's a number of question marks around the likes of the debt ceiling over in the US, the banking crisis. If something like that rears ahead, then of course we're looking at a very different picture. And if we're looking at a move into havens, I would favor the US over the Japanese yen. But it really depends on where that move into the havens comes from. If it's off the back of the potential for a default because they're not actually having an agreement in Congress, then you're not necessarily going to be looking towards the US dollar. So certainly the source of that risk-off move is going to be really key. But unless we see one of those rear ahead, I think we're likely to see equity markets continue to hold up relatively well. I don't think they're going to really boom, but as long as they're holding up relatively well, I think we're likely to see strength for some of these European commodities, in particular against the US dollar.
Yeah, okay. I mean, I think that's given us quite a lot of a focus on what's been coming out. Just give us again those headline figures of exactly how those inflation numbers came out.
Yep, so it was 5.6 down to 5.5 on the core reading, the headline number coming from 5% to 4.9%. So a nice move towards the downside. Remember, we're ticking down. We're just about ticking down, and we're somewhere away from that 2% target, so there's still a long way to go yet.
Amazing. So we will be back in a little while. We're winding down here at the Finance Magnets Africa Summit. There's still a lot of people here, still a lot of people milling around and talking to us, and there's still a lot of people that are interested in what we're talking about here. So we'll come back on in a little while. But for now, thank you for all your questions. Thank you for watching, and we'll see you again soon. white, right? Yeah. Went crazy. Hi guys, and welcome back again to the live stream. So we're here just kind of wrapping everything up from our perspective. This is obviously the Finance Magnets Africa Summit. I'm here with Linton White, who is the General Manager of Scope Markets South Africa. And we're going to just chat a little bit around, you know, what's been going on here over the last couple of days, how important everything is here, and you know, how important it is to have this show here in South Africa, and what it kind of means for us going forward as a company. Obviously, Scope Markets are the continental sponsor here of the show. This is our booth. We're inside our booth, booth number 1 at the convention. So, Linton, I mean, first of all, I think the big thing is, what have you seen here that's really caught your eye? There's a lot of people here, right?
Yeah, I mean, I think it's been a really busy event. I actually expected day 2 to be a lot quieter than day 1.
Yeah.
And to be honest with you, it's been a very successful 2 days in a row. I did. Oh, there we go.
Yeah. Yeah.
So I think the thing that's really caught my eye is the amount of participants that are here, as opposed to just companies and brokers and tech providers, etc. There's a lot of actual market participants that have attended this event, and I think that's really cool going forward.
It shows there's so much appetite, right? You know, there's so much appetite in we're obviously in Johannesburg, but in the country in general, you know, there's so much appetite. And this is the key thing that I've found as well, that usually you go to these, we've been in this industry a long time, right? And we go to these things quite a lot, and you see, you know, you're accosted by payment providers and whatever. There's actually not that much business that actually gets done, but it's been a lot of individual retail clients and IBs.
Yeah, no, there's been loads. I mean, I spent probably the entire day yesterday speaking to retail rather than speaking to the actual brokers and providers. And probably did a lot of business yesterday as well. So very excited about that. It's actually the first time that I've attended an event like this that's had such a big retail component at the event itself. I think it's really good for the market.
Yeah, sure, and exactly. And from a Scope Markets perspective, I think, and Linton, obviously you being the GM here in South Africa, I mean, we are kind of really relaunching here in South Africa, and the key aspect to that is obviously our new ODP license. You know, the ODP license, we are one of very few brokers that have this key legislation. But I mean, just tell us a little bit about how important that is to people here in South Africa, that key legislation, having that. And I know, look, from a major perspective, an individual client doesn't necessarily care too much about that, but it's the safety aspect, right?
Yes, I'm glad you brought that up. It's probably the most important thing that new traders, retail traders, anyone in the market needs to look at is this ODP regulation. That is also something that stood out to me here, is that most of the people that I was chatting to had heard of it, but they don't really know what it's all about. It's a really, really big thing, and I've got first-hand experience in what happens if you don't have one. So the company I was at before, we were in a situation where we didn't have the ODP. I'm not going to go into too much detail, but essentially it was a compliance thing, and the company was shut down. Traders' funds were frozen for a period of time before they could get access to it, and I think that is a very big thing when it comes to security of funds. If you're someone that wants access to your funds and you don't want to be in a position where it's frozen, you can only deal with a broker in South Africa that's got an ODP license.
And that's
essential.
It's fundamental. You know, whenever you're putting money into anything, whether it be a trading account, you know, it be a bank account, the safety of those funds is the key thing. You know, and that's why it's so important, this ODP regulation. Let's just give us one. You know, just kind of finish off. Obviously, from a Scope Markets perspective, it's been great to see all these retail clients. You know, what's the key message you would give to a retail client that's looking to trade for the first time, maybe watching this, wanting to get a bit more information? Obviously, we've been doing stuff with Josh around education, around the market. Something key at Scope is that education aspect and educating our clients, not just leaving people to get on with it themselves, you know, just educating us. But what would be your message as, you know, GM, we're trying to entice people to come to us, you know, what's the key assets behind Scope?
So I think the key assets and a big thing in this industry is transparency. I think there's a lot of not so transparent brokers who are in the market at the moment and pushing really hard. And I think that brings a big element of risk to the market and to trading itself. So the biggest thing I'd say to guys like that is be sure that you're dealing with a transparent brokerage and a transparent business, that you have access to education, that the broker has your best interests at heart and not only theirs. You know, it's got to be a fair, solid platform. I think there's often periods where we hear, especially in the South African market, you know, someone's trying to close a trade and it doesn't close, or trying to open a trade and it doesn't open, and you know they get this off quotes error message. And I've been testing the Scope platform through and through, and it hasn't happened to me once.
Yeah, sure.
And that's something that's huge. I think that brokers use that to their advantage. And most of those guys don't have an ODP.
No, exactly. Yeah, exactly. You know, you can hear, guys, you can hear all the hustle and bustle going on here. It shows you how many clients are here, you know, how much retail is here. There's a lot of people here. There's a lot of individual traders here that are you know, enjoying the events here. Linton, thank you very much. You know, thanks for taking the time. Just, you know, one last thing to say, you know, we're here in Johannesburg, right? That if you want to come and see us, come and see us. We'll pick up the phone, go to our website, you know, and we're here and we're transparent. And this transparency doesn't mean anything unless, you know, you test it yourself. So we're open, our staff's here, and, you know, there's a lot going on, right?
Most definitely. We're currently at 96 Rivonia Road, for those of you that don't know. And we are moving to the WeWork building on West Street. So it's a very, very accessible area. It's a very accessible building. And I'd invite you to contact me personally, and we can set up an appointment. You can come through and see us at the office. It's really getting rowdy out there.
Yeah, it's getting rowdy out here. So we better finish off because you probably can't hear us. So we'll finish off. But thank you very much for listening to us over the last couple of days. We've been really proud to come out here and be in Johannesburg, you know, supporting everybody here, supporting Linton and the staff here, you know, and our booth and everything that we've done to come to South Africa shows you how important this region is to Scope Markets. You know, Linton's here, the guys are here. We've got so much. If you're in the area, come and see us. But apart from that, thank you very much for watching, and we hope to see you again soon. Thank you.
Take care. Cheers, guys.